Are we actually closer to a Fed pause or even an outright cut in interest rates? Joining me now is Daleep Singh, Chief Global Economist over at PGIM Fixed Income, along with our own Rick Santelli as well. Gentlemen, thank all of you for being here right now. Rick, I want to go to you. Steve laid out an interesting case with regard to what the data could suggest. Is there anything in the markets right now that is painting more of that disconnect picture between what the eco data suggests and what the expectations actually are?
Well, it's a game changer to be sure, but interest rates look like they haven't been affected dramatically. And the problem with that reasoning is that the flight to safety and the recent spat of weak economic data have so depressed yields that this new news, which in my opinion is a game changer, might look like it just fitting in, but it really is a game changer. Steve had some good lines, but let's go to the real numbers real quickly here. You know, if you look at continuing claims, we hadn't had 1,713,000 in 4 weeks. And it wasn't many over 1.7 million, as you see. Now look at the new data. Not only did we have 1, 2, 3, 4, 5 in a row, we have 3 in a row above 1.8 million. And if you look at continuing claims, the psychological level of 200,000, we had 1 in the last 4 weeks. You have to go all the way back another 9 weeks. Now look at this. We have 1, 2, 3, 4, 5, 6, 7, 8, 9 in a row that are above that psychological area of 200,000. Why is any of this important? Well, we have a 3-day weekend in the U.S. with the holiday tomorrow. We have a 4-day weekend with Europe with the holidays. And all of this is going to happen when we release potentially the biggest number ever tomorrow in jobs. After all these revisions going back to 2020, anything can happen here, Dom. We have recalibrated on the fly, and it really does just to put in bold letters what many, including myself, have been saying. I don't trust the data.
Rick, I know we want to get to Daleep, but I like what you said at the beginning. The market's already there. The market already has this weakness built in. And when you look at the Fed funds outlook, January 2024, I know Rick gets me excited about this economic data. I wasn't excited when I talked to him. But here's the thing. You look at what's happened to yields and things. The market says, you know what, we're going to have this weakness. It didn't know about the proof, but it felt it out there, and it was priced that way.
Daleep, so let's bring you in. What a time.
Look at it another way, though. Hold on.
Okay.
Look at it another way. If you're thinking there's a bounce back after the flight to safety, think again.
That's a good point.
That's a good story. A combination of both.
So the markets are certainly playing out. So Daleep, to both of these gentlemen's points, what a time to be alive when you're the head of fixed income and those instruments and these types of markets. It's got to be a time when you're maybe a little bit confused, or is there something that you can take away from this mishmash of economic data?
Yeah, the data got Rick excited. But look, I think risk management principles tell you if you're the Fed, it's time to pause. You know, hiking another 25 basis points, it can produce a small incremental gain in terms of cooling inflation. But at this point, it risks a much larger and nonlinear amount of pain when the fragilities in the banking sector are still high. And when we're seeing more evidence now of an inflection point in the labor market with the high frequency data. And look, if you want to land this economy softly, you can't be strictly dependent on the spot data. You have to be forward looking. And that's why you have to look past some of the lagging indicators like inflation, which will probably look sticky next week. And you got to focus on the rate of change in the leading indicators for the labor market and make a judgment about the size and the persistence of the shock in the banking sector, which I think will be large and will have a long tail.
Now, Daleep, with that, if that's the case and if that's what your belief is, then the markets do have it correct right now. We have seen this kind of bigger medium-term move in rates lower as a bid for government bonds has come because of perhaps fears of a softening economy, perhaps because fears of a credit tightening, because of fears of a possible recession, hard or soft, whatever you want to call it. So then what's the path forward? Is it going to stay this way for a while, or are we going to see some kind of a volatile bounce back in some of those yields if the data is not the way people think it's going to be?
Whenever you get a shock, markets tend to overshoot. And initially after the SVB news, you saw rates markets overreact to some extent. But I think now they've settled into a territory where I actually don't have a disagreement with the market. 2 to 3 cuts by the end of the year after a peak of around 5% in Fed funds. That seems about right to me.